let me just see if it's time. Okay, there we go. It's gone 2 o'clock. So I would like to welcome everybody and thank you very much for coming here today. It is very nice seeing old friends and meeting new people. I would like to welcome today Erina Nanyonga. Do I say your name correctly, Erina? Okay, you muted. You are our speaker, so you can keep yourself unmuted. I need to mute myself. There's noise on my side. So I would like to welcome Erina. Thank you very much for taking the time today, Erina, to prepare this talk. You can share your screen, your presentation, please. And then everybody, there's noise on my side. I'm going to hand over to you, Erina.
Okay. As already introduced, I'm Erina from Makerere University. My presentation is about stochastic modeling of stock prices in an illiquid market. The outline is I will start with an introduction, which has the background of the study, the problem statement, the objective of the study, and then the significance of the study. Then I'll have literature review on what I studied, and then the models that I used, and that will be followed by a performance measure that I used to test the forecasting accuracy of the models. I'll show my results and finally conclude. I'll begin with a stock market, which is a global system of financial markets in which individuals and institutions buy and sell publicly traded companies. So a stock market can either be liquid or illiquid depending on the number of buyers and sellers at a given time. So when it's liquid, it's very easy and not risky to trade, while when it's illiquid, the process is slow and risky. Though the process of being illiquid can be temporary or permanent. A stock exchange is a regulated or centralized marketplace, and in South Africa, the largest stock exchange is the Johannesburg Stock Exchange, which is actually the largest in Africa. And then in Uganda, where I come from, the main stock exchange is the Uganda Securities Exchange. The Uganda Securities Exchange, as I've said, it's the main stock exchange with very few companies listed. Currently, there are less than 20. While at the Johannesburg Stock Exchange, the number of companies listed are about 400. Being a liquid market, Johannesburg Stock Exchange has so many big companies listed with a number of financial techniques that can be used to model the stock prices. While at the Uganda Securities Exchange, the prices are most of the time constant and do not change from one day to the next, as it can be observed in Figure 1, Part B, where prices, this is one of the stocks at the Uganda Securities Exchange, SBU. In the year, these are the prices of SBU, which is Stanbic Bank Uganda, from 1st March 2023 to December 2023, where they are moving up and down and then constant sometime. Comparing the prices with Standard Bank at the Johannesburg Stock Exchange, which are liquid, they are always moving up and down, which reflects a liquid market, and the one of SBU reflects an illiquid market, where the buying and selling is quite risky. As I've said, in an illiquid market, we have a very big difference between the bid and offer, and sometimes there is no bid and there is no offer. It is always difficult to trade assets at desired quantities in an illiquid market. For the liquid markets, buyers can be able to buy and sell assets at any time they want with hopes of making more profits, unlike which can be the case in an illiquid market. At the Uganda Securities Exchange, almost all stocks are illiquid, though there are some companies which are considered to be big in Uganda but not in Africa as a whole, whose prices are also moving up and down but also constant, like the one of Stanbic Bank Uganda that I have shown in slide 1. They move up and down and constant most of the time. And at the USE, the Uganda Securities Exchange, it's considered to be one of the liquid stocks, and yet its prices are constant most of the times. When the stock prices are compared for different stocks, they actually have different trading days. For example, Stanbic Bank is in the financial sector. When we compare it with another company, let me say Uganda Clays Limited, the number of trading days in a given year, for example, if I had illustrated the stock prices for Uganda Clays Limited in 2023, they are not the same as those of Stanbic Bank Uganda. That shows that the Uganda Securities Exchange is illiquid, where stocks have different trading days. Unlike in a liquid market, in this case, I chose Johannesburg Securities Exchange's stocks, but there are so many other liquid markets in the world. The fact that I visited South Africa, I chose Standard Bank as an example because it's the largest stock exchange in Africa. It is a very good illiquid market example. The illiquidity of prices at the Uganda Securities Exchange can be studied, and it is affected by a number of factors which can be deterministic and random or unpredictable. Among the deterministic factors we can have that influence stock prices at the Uganda Securities Exchange, which is an illiquid market, we have government rules that are set. We have interest rates for the companies, and then the news random factors for a given company. Disease outbreaks can also influence stock prices in a stock market. But in financial math, Brownian motion is used to describe randomness. That random movement of prices moving up and down is described by Brownian motion. And there are so many models that are based on Brownian motion to model stock prices. Characterizing the random process that drives a given stock price, that stochastic movement of prices up and down, is very important to create stock portfolios and make investment decisions that are profitable. If we consider a two-state Markov model, we are going to consider the simplest Markov model, the Markov chain, with two states, where the first state is considered to be a case when where state 1 is a case when prices change. They can either change to be high or low. That we consider that was considered to be one state. And then the second state, state 0, is when the prices remain constant, when they don't change. When the price today is the same as the price tomorrow. So prices in the Markov chain, prices can move from state 0 to 0 with a probability P, and then from state 1 to 1 with a probability Q, and they can switch with these switching probabilities. In this simplest Markov model, an action can be repeated where it allows a state to be, where it allows a price to be constant from day to day, and it can either be constant from day to day or it can change from day to day or move from one state to another. So since this Markov model, I'm going to use as the two-state Markov model, since it allows the repetition of stock prices because it allows an action to be repeated a number of times, which can be random. The repetition of stock prices at USE was captured by the the two-state Markov model, and the up and down movement was captured by the exponential Ornstein Uhlenbeck model, which is an SDE, which is a stochastic differential equation, a differential equation that contains randomness, and geometric Brownian motion, which is the simplest stochastic differential equation. This is the problem that we are aiming to solve in the study, where the stock market modeling is, where it was developed from the fact that stock market modeling is challenging due to its dynamic, complex, chaotic, volatile, and noise nature, and that we have the stock prices at the Uganda Securities Exchange to be moving up and down, but most of the time constant. That's a very big problem in finance, and it's risky. It makes investors' decisions risky and non-profitable. So when models with insufficient performance are used to make decision support, like models in liquid markets, when they are applied on the illiquid market, the Uganda Securities Exchange, wrong decisions will be made by investors and stakeholders in the investment structure, therefore making losses. So there is need for techniques and models with sufficient performance that will provide relevant explanations and predictions of the stock price movements. And the objective of the study is to model stock prices in an illiquid stock market, which will help to make profitable investment decisions with insights on future behavior of the stock price dynamics at the illiquid stock market, Uganda Securities Exchange. It will also provide a basis for informed decision-making and investment risk management, which will maximize returns. The price models that we used in the study are also important to determine hedge ratios, which calculates how much risk can be eliminated when an investor opts for hedging. So the literature review, we are not the first people to model stock prices, and a number of models in financial mathematics, we mainly focus on stochastic differential equations, but they are not the only models that model stock prices. There are other models like machine learning models, statistical models like the Gauge models, the AMA models, but we are focusing on stochastic differential equations due to the stochasticity in the prices, in the stock prices. So the simplest stochastic differential equation, GBM, it's abbreviated as GBM, was first used by Samuelson in 1965 to model stock price dynamics. Then another model that is mainly used is a mean reverting model, the exponential Ornstein Uhlenbeck model, described by equation 2, where this is the mean reversion speed and this is the long run mean. It was my colleague and I used it in 2023 to predict stock prices at the Uganda Securities Exchange. But this is a model that allows prices to be moving up and down, which doesn't reflect the market scenario at the Uganda Securities Exchange. So we aimed at making a model that is relevant to the where prices move at the Uganda Securities Exchange by catering for the constant moves, by bringing together the exponential Ornstein Uhlenbeck model and the model that I talked about, that I introduced before. And we are not the only people who use the exponential Ornstein Uhlenbeck model, but in 1997, Schwarz also used it. In 2013, Vega also used it to model stock commodity prices. Actually, there are gold prices. Then more details on the Markov model that we handled. The Markov model, if we consider a sequence of state variables, the Markov model incorporates or uses the Markov assumption on the probabilities of these sequences, that the current state doesn't depend on the past states, but it only depends on the previous state. And it is characterized by the following components. There are three. We have then states, and in this case they are finite. We have state 1 and 0. State 0, where it's the case when prices remain constant, and state 1 when there is a change in the stock prices. Then another component of the Markov chain, or the model that we considered is a transition probability matrix, or which is obtained from transitions, from the probabilities of transitioning from each state to another, and then the initial probability distribution over the states. In that model, if the current state, as I have already said, if the current state of the process is known, there's no additional information about the previous states that's needed. It uses the Markov property that it's just best to predict the future using the most previous state, because the current state only depends on the most recent state. The model allows an action to be performed at varying speeds and also to be repeated a number of times. That's why actually we opted to combine it with the existing SDEs to model stock prices in an illiquid market, the Uganda Securities Exchange specifically. When it's not combined, it can also be used to predict stock prices, as this person used it in 2021. And other Markov models can incorporate hidden states, which we didn't do. And it's suggested that the market process is hidden and it's not completely observable, but in our case, our states are observable. There is a state when the price is changing or not, when we are not considering hidden states that influence the states of the prices. we are considering the observable state 0 and 1. So the fact that we are using two SDEs to be combined with the models, these two SDEs, the exponential Ornstein Uhlenbeck model, which is a mean reverting model, and the simplest GBM model, the simplest SDE, the GBM model, both were opted for due to their positivity. They always, when used to model prices, their prices are always positive. They never go negative. So due to their positivity, they are log normality, and actually they are more adherent to the economic reality. Therefore, in our study, we modeled stock prices of our illiquid market. It's not that we are to apply the models that we came up with on each and every illiquid market, because every illiquid market is illiquid in its own way. We might find that we are saying that Uganda Securities Exchange is so illiquid, and find that the one of Rwanda is more illiquid than the one of Uganda, and we might find that the models might not give the same performance. So specifically for the Uganda Securities Exchange, we considered the simplest model, this GBM, then the combination of the model and the GBM, the XOU model that we used in 2023 still on the same exchange, and then the combination of the model and the XOU. So for the combination, as I already said that the states are only two. For the combination of the XOU model, this is the model describing the combination where we are having the move in the prices to be described by the exponential OU, and 0 or nothing to describe a constant change in the prices. And then for the GBM, it's the GBM that is driving the movement in the stock prices. So these are the two models that we are calling the combined models, and we use them to model stock prices in an illiquid market. The performance measure that we use to compare the forecasting accuracy of the four models was the mean absolute percentage error, where the price, where the MEP, where when the MEP value is low, the model prices are considered to be close to the actual values. So let's now have the results of the prices that we modeled. We first of for the Markov models, we had to get the transition probabilities to form the transition probabilities matrix. For each data set, we considered stocks at the Uganda Securities Exchange, mainly the ones that are considered liquid at that illiquid market, and counted the number of days when the prices were constant for each stock and when they're moving. So the P was the transition, the probability of leaving state 0. Sorry, it was the probability of remaining in state 0, and Q was the probability of remaining in state 1. And then the switching probabilities were 1 minus P and 1 minus Q respectively. So the fact is that if P and Q are close to 1, if they are all high, the maximum value they can take is 1, the chain tends to stay longer in the same state. So if P is very high and Q is low, the probability of staying in state 0 is high. And if they are equal, the next state is equally likely to stay or switch. And if P or Q are small, are very small, close to 0, the chain switches states almost every step. So for Stanbic Bank Uganda, for the days that we used to calibrate we use the same number of days to calibrate all the 4 models. We used 200 days from 2016 to 2017, and the number of repetitions in the data were more than the movements. So the days that remained after cleaning the data were 73. Cleaning, I mean removing the repetitions. So we remained with 73, meaning that out of the 200 days, only 73 days remained after removing the data, and this helped us in generating the values of P and Q. So for the GBM model, we ended up with 4 parameters, 2 from the GBM model and 2 from the model. This is the GBM with 2 parameters, and then the 5-parameter model came up to be the XOU. The 3 parameters from the mean reverting XOU, and then the 2 parameters from the Markov model. The data was the same, therefore, the transition from 0 to 0, the probability of transitioning from state 0 to 0 in the GBM was the same as the probability of transitioning from 0 to 0 in this other model. From the data that we use here, it's seen that the probability of transitioning from state 1 to 1 is lower than the probability of transitioning from state 0 to 0, yet this is one of the liquid stocks. So we modeled the next 50 days after 28th June 2017, using these models for each model independently, and came up with this. The mean absolute percentage error for the combination of the and GBM was 0.2413. The one of GBM was 0.8487%. The mean absolute percentage errors are in percentages. Then the combination of the XOU was 0.3, and then for the exponential oil, 0.4872. This shows that the combination of the Markov Model and the simplest SDE gave more accurate results for Stanbic Bank Uganda when used to model the next 50 days compared to the other 3 models. So the and then the GBM and XOU were better than the other models that are not combined with the since they allow an action to be repeated from the properties of the that we used. For the GBM and the XOU, the prices are modeled to be moving up and down always, and there are no cases when they can be constant. The and GBM are are reflecting the market scenario at the Uganda Securities Exchange, where the prices can stay constant for a given time. So even when the number of days to be modeled were lower to 30 and 20, still the combined models outperformed the models, the SDEs alone. Another stock at the Uganda Securities Exchange is Bank of Baroda. The 200 days for calibration were from 2022 to 2024. This was actually after COVID. And the one for Stanbic Bank was before COVID-19. So after cleaning the data, the days without repetition were 43 for this other stock out of the 200 days. And then the probability of transitioning from set 0 to 0 was very high, to 0.8846 in that specific time period. And then transitioning from 1 to 1 was 0.5714. In each case, the volatility of the models that were not combined with the MM were smaller than those of the MM models, because the SDEs, the GBM or XOU, were calibrated using data containing repetitions, yet the MM models were calibrated using cleaned data. So after cleaning the data in the GBM, then the GBM was later used to predict the prices without the constant prices. So for the Bank of Baroda, the map for the GBM was 0.7. The one of GBM was 1.43. Then the one of the XOU was 1.4. And then the XOU performed poorly with 9.85%. We also tried to model the prices for the Uganda All Share Index. This is not a company listed, but it's the main stock index that tracks the performance of all the listed companies at the Uganda Securities Exchange, and its prices can't be constant because it tracks the performance of all listed companies. So this was done to test whether the MM models and GBM models will also perform better than the GBM models in a case when prices were not constant most of the time. In this case, out of the 200 days, only one scenario was found. We only had one case when we had constant prices, and then 199 days moved. Therefore, the P in this case was approximately 0, and then the Q was high. That probability of transitioning from state 1 to 1 was high, meaning that the prices were never constant actually. And then the volatility of the of the models that were combined with the models was close to the volatility of the SDEs alone. Then for the GBM, even for the mean reverting model, the parameters were also they were similar, with the volatilities being close to each other, unlike in the previous cases where we had the volatility of the SDEs being lower than the volatilities of the combined models. So for the all shares index, the MAP values from the GBM for the GBM and GBM were close to each other, and those of the XOU and XOU were also close to each other, implying that the effect of the model was irrelevant for data that was moving. So in conclusion, I can say that the GBM outperforms the other models in an illiquid market while modeling closing prices, especially for a short time period. And the XOU outperforms the XOU for the stock prices at the Uganda Securities Exchange. And additionally, the zero price moves in the stock prices at the Uganda Securities Exchange arise from insufficient speculation to accomplish price discovery, which can't be found in a market that is liquid. This is caused by the low level of speculative traders at the Uganda Securities Exchange to participate in making sure that the information in the market reflects the prices. So like any other data-driven model, the combined models that we used can only describe the future, depending on the fact that it behaves like the past. These are some of the references that were used. And thank you for listening.
Rene, you are muted. It appears Rene is not here. Maybe has abandoned the computer. I'm just suggesting that now that the speaker is done, can you take some questions of the speaker? Any questions? if you have a question, there's a question in the chat here. So, Erina, the question goes, regarding the Stanbic Bank Uganda results, the p-value for your models was quite high, 0.7. Does this effectively confirm that a significant portion of trading days for the stock exhibit no price change, reinforcing the need for your Markov modulated approach?
Regarding the Stanbic Bank Uganda results,
Yeah, I think that's the way that he
the
is putting.
p-value being very high implies that the probability of the stock prices being the same for the same consecutive days is high. Does that answer the question?
But are you satisfied with the answer?
Yes.
Okay. Erina, myself, I have a few questions. First of all, thank you for the very nice presentation. But okay, I have like 2-3 questions and some comments. The first question is, which method do you use to obtain the parameters? Because you obtain all these parameters for the different models, but which method are you using?
For the stochastic differential equations, let me start with the mean reverting model. The MLE, the maximum likelihood estimator, was used. And then for the GBM, the maximum likelihood estimator would be used, but the average of the returns and their standard deviations were opted for. And then for the combined models, these are the parameters from the MM model, and then the other 3 are parameters from the XOU model. And then for the GBM, these ones still are from the model, and the other 2 are parameters from the GBM model using data without repetitions.
So when using maximum likelihood estimation, do you assume that the likelihood is normally distributed, or it is a quasi maximum likelihood estimation? Because it appears you use maximum likelihood estimation if you know that the likelihood is normally distributed. So do you have an idea about the distribution of the likelihood in this case?
Yeah, the maximum likelihood estimator is opted for because actually we are using the logarithm of the prices, and from the central limit theorem, the adding up those prices, because we are using a number of days to calibrate the model. So from the central limit theorem, those prices, that sample is large and normally distributed.
Okay, if the logo prices, it makes sense. Okay, the other short question is, how do you handle dividends? Because a practitioner, a trader would be interested in how you're handling dividends. Assuming that the stocks are assuming that the stocks are non-dividend, non-paying when it comes to dividends.
I have not got your question.
No, my question is, you see, if you write the GPM, for example, if you write that SDE of the GPM, so there's a component, that component, the drifty, no, the deterministic component, it has that mu, the parameter mu, but also it should have, in its full form, it should have the component for dividends. So my question is, do you include these dividends in your modeling or you don't?
No, we are only working with stock prices, the daily stock price movements, actually.
Okay, maybe it would be also good to look at a situation where you incorporate the dividends in the modeling. Let's remind me, the other thing is just a comment. I think you gave a very good literature review, but it would be perhaps important to push back to as far as 1903, because if you check the literature, you see that the first person to write stock prices in using a stochastic process was the Lloyd Bacheria when he came up with what we call the Bacheria model. So you can check right in the literature, it exists. So, but you see that that model, of course, has a problem which is circumvent here, because the issue is that model is that the stock prices can turn negative. Yeah, but something is circumvent here, but the story of modeling stock prices using stochastic processes goes back to Roy Bacheria in 1903. That's when things started. Otherwise, thank you very much for that next presentation. So that's all from me. Can we take more questions from other people?
Yeah, maybe to add on what the previous speaker said, Samuelson was the first person to use the geometric Brownian motion model, not the Brownian motion model.
Okay, that's noted. Thank you. It appears we don't have any more questions. Okay, just a few seconds to see whether we have any other question. Yeah, Richard says he has a question. Yes, Richard. Ask.
Hello, everyone. First of all, Erina, congratulations on your very nice presentation. I'm very happy to have gotten the opportunity to attend. One, I have a reaction to what Nelson asked about the model not capturing, for example, dividends. Normally, the prices at the exchange are adjusted to capture some of these items. For example, the dividends when they are paid, or when there's things like stock buybacks and those things. So if she's evaluating the drift and the volatility based on the closing prices or the adjusted closing prices, then it indeed captures all these items. And my question, when I look at the prices, for example, if you go to that page where you had, I think Stanbic, and when we look at the prices, the chart with the prices. I think it's probably the next one, 15 here. If I look at the closing prices, I see that most of the movement is actually due to jumps. So we see like the price is almost constant and it jumps, and so maybe you can also think about working with a stochastic differential equation which incorporates in jumps. I think it will probably improve your model more. But otherwise, a very good presentation. I've enjoyed it very much. Thank you.
Thank you, Richard. Just a follow-up comment about still they show dividends. So on Erina's slides, I see closing prices, not adjusted closing prices. If they're just closing prices, they have not yet been adjusted for dividends. Richard, do you agree with me?
Yes, I agree with you. So, Erina, maybe you work with the adjusted closing prices, so you can capture some of those hidden changes.
Okay, we're about to close. We had up to 1 hour. We have about 8 minutes to the end of the hour. So we can take a few more questions if they are there. Okay. It appears there are no more questions. So just say thank you again to Erina and to all the people attending this talk. I can see Erina's supervisors on the call, that is the Prof. Davidson and the Prof. Kasozi. Thank you for joining the call. Yeah. Okay. So I think it's okay to leave.
Thank you very much to everybody. Thanks for being here. And Erina, thank you. And thanks for everyone that organized it. Thank you.
Okay. Cheers.
Bye-bye. Thank you. Take care. All the best. Thank you.
Bye.
Bye-bye. Bye-bye.